There it is. Okay. All right. So we have commenced. I am Tim Quast with Market Structure Edge. This is the Market Structure Edge live demo and discussion. Maybe there's a better name. We should shorten it, right? Nice compact name. The last one of 2024. We were just saying, that next Thursday is the day after Christmas, and I'll be en route to Nashville, and Brian will be out, and then I'm not back till I like the 5th of January. So we'll pick this up January 9th. We'll make sure that that is clear to everybody. We'll put a system message out, make sure it's in the market desk notes, but you will get a lengthy break from us. So today, Brian Wilson is our market strategist is here, and he's going to take the first half. I'll take the second half. I've got a list of, I mean, if I hit them all, there are 5 things I would like to cover. They're not lengthy, but I think they're important. Again, please ask questions. We want to make sure that we address those. If I miss them, I try to go back and look to see if I missed a question and get back to you if I can. Okay, Brian Wilson, over to you.
Terrific. Thank you. Thank you very much. Good to see everyone. If we don't have a chance before the holidays, just wanted to make sure to wish everyone just a wonderful holiday period. Tim and I and the whole Market Structure Edge team, hope that it's just a wonderful holiday season for you and your family. As I start today, I thought I would start with the short portfolios. We had a discussion last time about this, and I thought it was a good discussion, and we had some feedback afterwards. And let me show you what this looks like. I have a couple of portfolios. One of them I call it quite simply my Barry short portfolio. Barry Norton came up with this one. This is my regular short portfolio. Let me show you the dynamics for each one of them. They do differ. What Barry is trying to do is he's trying to catch companies essentially that are tens. So he's basically trying to catch companies that are falling from like being momentum companies. And let me show you the dynamics here. If you're interested in taking a screenshot, feel free to do so. The key dynamic here, it's basically the opposite of the momentum portfolio, but it's capturing companies that are moving lower. So market structure sentiment equals down. Sentiment is less than or equal to 9. I think all the other parameters are identical to our regular momentum portfolio. But once again, this is catching, basically think of it as catching the high flyers that are now starting to move back again. So that's what I call the Barry short portfolio. And then let me show you the other short portfolio. And the way that Barry kind of tracks these, I don't know if he's necessarily shorting individual names, but I think it just gives him a good feel for what's happening in the market. So in other words, hey, yesterday there was 10 names in the portfolio. Today there's 20. Wow, the market's really turning now. The other portfolio, it does differ. This one is looking at sentiment that is moving below 4. So all the other parameters are exactly the same, but this one is looking for companies that are really starting to break down. Now, could this be set up slightly differently? Sure. I just set it up at 4, maybe 4.5 is a better number. I'm not sure. If you're interested, you can experiment, with it. But once again, the way I use it, I'm not looking necessarily to short individual names. You might be, but I'm looking at it more of just a cadence for what's happening in the market. So just kind of wanted to walk through those two portfolios. Once again, the Barry's short portfolio is tracking those high flyers that are moving lower. This one is tracking the companies that are really, let's say, really starting to fall apart a little bit. So I won't spend a lot of additional time with that, but just wanted to mention that to you. I didn't want to mention the daily trading ideas. I do this every single day. It's an easy exercise for me. And I usually track the momentum portfolio. It's a rare exception that I'm then I'm looking at low volatility. Nothing wrong with low volatility. I would just rather, earn 2 or 3% rather than earning 1%. But I'll just take the names, and then I'll quite simply put them into a watch list. And I just have it here on the left-hand side of my screen. And depending on what's going on in the market, it is kind of where I'll look at them during the course of the day. If the whole market's much lower at the beginning of the day, and I see certain names that are kind of bubbling to the surface and are doing well, that's a signal that money is flowing into those names even when the market is weaker. I might enter into some of those positions 30 to 45 minutes into the day. Otherwise, I'm usually waiting until the end of the day and then kind of looking at those positions, similar to what Tim does, maybe 5 or 10 minutes before the close, looking for some of the opportunities that might present themselves. So, not a huge discussion point, but once again, just looking at those names, trying to make sure I'm between the entry low and entry high. If the name is getting away from me, I'm not going to chase it higher. It's just too difficult to make money in that environment. Tim's going to have a discussion point about volatility, so I won't steal his thunder, but I will bring up one item here. Let me move my share screen. And this item has to do with the volatility surges. It surges itself. What you're looking at here in blue, S&P 500. In yellow, you've heard us talk about this a little bit. It's UVXY. It's a very short-term oriented trading vehicle capturing volatility. But as you can see over time, what generally happens is this name tends to deteriorate over time. Everyone tends to go into low volatility instruments that deteriorates this over time, and then you'll have these volatility surges. These surges do not last very long. This is the one in July. It lasted, I believe it was 3 trading days. The S&P 500 was down about 6%. It's a little hard to see, but it was down about 6% in the beginning of August. If we fast forward a month to September, you can see once again a surge in UVXY. Market was lower by about 4%. We saw the same thing, not to the same extent, but a little move higher UVXY end of October. And that divot didn't last as long as, of course, we had the election right there that moved the market higher. And this is the last one. So just the takeaway here, and once again, Tim will have a couple of other points to discuss regarding volatility. But one thing to think about, these volatility surges do not last very long. They can be very, very profitable. Similar to Tim, I was long UVXY going into yesterday, and I think on average I made about 20% on that trade. My position was smaller than Tim's, so I was able to kind of hold on to it because it's obviously moving back and forth a lot, and I kind of went out of it in I think it was 5 different tranches. But they can be very profitable. But once again, it is a short-term play, and that this trade will just deteriorate over time. It's not a long-term holding. So just wanted to discuss that with you. We did mention, and you've seen it on your dashboard, broad market sentiment has moved below 5. We're all the way down presently to 4.2. And I wanted to share one observation. I need to update this. But this is information as it relates to sentiment below 5. And you can see the date, the time frame here. It's December of 17 to June 2023. Most of your market losses are usually going to be right here in terms of if the market actually moves lower. Between 3 and 4, if the market really starts to deteriorate, the market starts to recover. And if it gets really bad, if the market falls apart, well, returns get very, very ugly below 3. So once again, central tendencies, but that's what we tend to see over time is, most of the market losses would be right here between 4 and 5. Most of the market gains, and we're looking at sentiment below 5. Obviously, the figures are different if you're north of 5, but this is kind of the market environment that we're in right now. So Tim, I do have a what's ahead segment, but do you want me to hold off on that for now and we can kind of cover that together?
Yeah, maybe so, huh? We'll
Okay.
circle back
Yeah.
to that right at the end if that makes
Yeah.
sense. Okay.
Sounds good.
Yeah.
Yep.
We have thoughts. We could be wrong. We are.
Right.
Right? So but we certainly have thoughts and opinions on it. Okay, thank you, Brian.
Uh,
So I have for the second demo and discussion in a row, uh, a need to correct a mistake I made. I I put a couple of you sent me notes. I think most everybody figured it out. I think it was it in the Tuesday market desk note? I said rate hike. It so that was and people, you mean cut? And of course I meant cut. It reflects my belief that it's a it's a spurious action on the part of the Fed. So it was a Freudian slip for me to say hike. Right? If indeed economic growth is we got the third read today on GDP. If indeed it's 3.1%. And look, I have long contended, and I've had these discussions with a half dozen Fed presidents. They're over the years I've gotten to know a number of those folks pretty well. Eric Rosengren, he's out. Probably most of all would be now his first name escapes me, and I talk to him all the time. Fisher used to be the Dallas Fed president. Had a lot of exchanges with him. Ran into him in Vail one time, and Charles Plosser. Um, Dudley. What was his first name? Anyway, over the years, I've had a lot of discussions and presented a lot of data to these folks about how I believe they count inflation, despite all the use of deflators. The Fed loves what's called the PCE deflator. Personal consumption expenditure deflator. So they try to back out the effect of inflation by chaining the dollars. So if you say, for instance, we're going to count GDP in 2009 dollars, they're going to try to back out inflation that way. And I've long contended that they do it poorly. So we end up counting inflation as a part of GDP because it's very difficult to do. It's a fact. So setting that all aside, why would you cut rates if there's 3.1% GDP growth? You would just be asking for more inflation to me. So to me, the only reason that they're doing it is to try to give other central banks that are trying to balance their currencies against ours some ammo. Because if our dollar keeps rising, other central banks have to sell dollars, and that's expensive. And so if we cut rates, the theory goes that the dollar would weaken. It didn't. It didn't yesterday. It spiked. So I'm sure behind the scenes they went, that didn't go as we planned. But anyway, I meant to say cut. That's the point of the discussion. Okay, so that's my error. Then I want to talk a little bit briefly, because I said I would, about ETFs in the basket. I said the reason that we had all of these deteriorating metrics, and I'll share my screen. There were a bunch of things which fed into my volatility trade, which I'll talk about too. Okay, so there, I think I am sharing my screen. I got a lag there for some reason. Let me go to the platform. And I want to pick up a slide in here. I tried to find a better slide, and I couldn't find it. I had a particular one in mind, and there are so many. We've given a lot of presentations, and I can't find it. So I wrote a fair amount about this, the ETFs versus the underlying basket. And I said, part of the reason that we've had this long deterioration in demand and slowly rising supply, and yet the broad measures didn't really fully reflect that. If you looked at the, call it an equal weighted version of the S&P 500, or the way we do, behind the scenes, we calculate supply and demand, all kinds of measures for the 500 components. and then we can run that data. And so we could see they were all deteriorating. In fact, I wrote that really for 13 out of the last 14 trading days through yesterday, they were closing below their midpoint. Well, it's a good way to understand selling. It's not perfect. It doesn't mean it's right all the time, but because there's a bid to buy and an offer to sell, which are never going to be the same. Now, the spread might be a fraction of a penny, but they'll never be the same. That's the law. That if buying and selling were perfectly balanced, the market would deteriorate because of that spread. So for markets to rise, there must be, people must be crossing the spread, so to speak. And it wasn't happening. Was not happening at all in the components of the index, and yet the index was performing okay. It was over that period of time up about 1% till yesterday. That took it all out. But we looked at that and said, well, maybe there's a cause. If you look at SPY, did not have the same characteristics at all. There was half buying, half selling, very well balanced. Well, what would that produce? Well, depending on how much you move over the intraday midpoint, the very gains that we saw for SPY, which were, 3% or better. Well, how could you have an ETF rising if the underlying assets were not? Well, the logical explanation within the rules would be that the people who are moving assets back and forth in support of the ETF were moving cash instead of securities. Look, you can do that. I've said we've read hundreds of prospectuses and statements of additional information and semi-annual and annual reports for ETFs from BlackRock, Vanguard, State Street, all of them. I mean, it's something we spent a bunch of time on about 5 years ago. And you can go look for cash in lieu. Now, there are provisions around it, but because there isn't a lot of stock readily available, institutions own the stock. And they're not, buying and selling it all the time. But ETFs are. They're constantly, they've got immense inflows and the need to deploy capital. Well, what if you don't have it? What if, what if BlackRock publishes a statistical sample of an index and says, we need these, 25 stocks. And so then Goldman Sachs, acting as the authorized participant, says, I don't have those, but would you take a check? So I'm joking on one hand, but I had this very conversation with one of the core people on the BlackRock ETF team. I had a whole list of questions and I asked her. I said, would you take one stock? She said it would be unusual, but we take good collateral. She would disclaim this entire conversation if you knew who she was. I said, would you take a check? She'd say we'd over collateralize at 5%, meaning if you're going to give us cash, you got to give us 105% of the value of the basket. Well, it's a lot easier than settling a basket of stocks or having to buy them. And I think in periods of calm where everybody is selling volatility rather than buying it, it probably becomes very alluring to do that. And it would explain why the broad measures continue to rise, because you have money feeding the S&P 500 as reflected in things like SPY, IVV. And those things go up, and there's a statistical sample that is rising, but the whole group isn't. And what if you're just moving cash back and forth? What if I sell the ETF, which means that Goldman Sachs or somebody similar buys those shares from me, because you can't go to BlackRock with an ETF. It has to go through an AP, an authorized participant. And that's Goldman, and Goldman turns around and gives the ETF shares back to BlackRock, and BlackRock gives them cash. Well, no stocks were sold. And it would explain the divergence. I'm not going to, that's a lot of weedy market structure data, but we're going to see that stuff to some degree in exactly what we observed here. Where things don't match. And I got notes from you users who are saying, look, are your measures breaking down? Maybe it would be better if you changed this measure or that measure. And I said, this is a very anomalous period. Out of all the time that we have looked at the data, this is one of the larger divergences we have seen from what we would expect would happen. And when I say what we would expect would happen, I mean this. That if you look at the demand supply balance, this is, you'd look at it and say, well, this was very unusual. This is unusual to have us. Now the market was bottom, but the way it behaved, wow, that was a juiced outcome. The election. So people had bets, and those bets paid, forced people got called, so to speak. Then you have this declining demand and rising prices. Declining demand, rising supply, and yet the market goes up. Well, it's very unusual. And for it to last any particular period of time is unusual. It's not a perfect measure. There isn't one. But when those things are happening, and for a sustained period of time, we suspect that there will be a reset. And when is the highest probability of a reset occurring? At options expirations, you know? So look what happened. There's a little green box right there, and this coincided with this plunge, which leads into this the next thing. So the next thing is these volatility trades, and I've gotten a bunch of questions, and I'll try to answer them, including, Benham, to your point here today, that, well, how'd you make 13%? I didn't make 13%. I wish I had been in that trade so long, but far past the time I usually do. I made a very significant wager on volatility that I don't normally do, not of that size, and certainly not for the number of days I held it, which was, I don't know, it was probably 14 or 15 trading days. That's a lot longer than, and I know I'm getting killed. It's deteriorating, right? There's time decay in it because it's backed by 1 day total return swaps. Every day that gets renewed. Well, it's very difficult in that situation to hold those things very long. So, I made an enormous return, but but that part of that return was consumed by digging myself out of the risk I took. And I sold it early. I mean, once I was like, whoa, I'm up 5% now. And then I could have made twice as much, if not more, if I'd have held it to the end of the day. But what are you you can't look at those and do anything else than kick yourself for a little bit of cowardice. But I can't set a 2% stop limit on that because there is no measurable demand and supply in an instrument like UVXY. It is entirely synthetic. It is purely a product of changing prices. And so the only time, and I got caught today doing it, you get cocky. I made a bunch of money today on UDOW. I went 3 times long the Dow because, why? Well, I mean, you can look at it, say it dropped 1,132 points yesterday, 9th or 10th day down. Supply has stopped rising. Demand is below 5. What's the probability that I get some kind of gain today on that? Well, it's pretty good statistically. So I bought that yesterday at the close, market on close orders of that, and a small hedge of SPXL. Think about that. SPXU short, very small, but then by 7:41 Mountain Time, I sold it. I made 3% on that, and I didn't have a big position, but it was it was 4 figures return on my tiny little investment in that of like $25,000. So the point out of that is then I'm cocky. So then I'm looking at UVXY and I thought, it's starting to turn around and run. I think I might buy that. Well, I got Citadel'd. I cannot out trade Citadel. It's just a stupid trade. So in 2 minutes, I lost $300 and immediately closed the trade. But there's no basis for that trade. The basis for the volatility trades, I'm going to go through this. This is because it's very important. You can't do it that often. But when there is a significant transitional change, demand is deteriorating, supply is rising, and then you add in how the market is not responding. Well, now, if the market is not responding to what I can clearly see it should be doing, it's either I'm wrong, the data are wrong, or there's going to be a reset. Well, which thing do I believe? Well, based on my long history with these data, and I shared last time, when we run correlation calculations 5 days out, we're very, very accurate. We're, 94.5% accurate on those across the entire market. Well, that's as good as our created prices are as good as the real prices at that level of correlation. And so I had a very high probability. Look, I might have to throw in the towel. But the good news is that whole time I was making up ground. Every day I was making returns in that UVX trade, but just a little, and then wham. So you can only do that when those conditions exist. You can't just go trade it willy-nilly because you'll get your hat handed to you, like I did in those 2 minutes. Just to, not the right way to trade that instrument. Had I stayed in it, I mean, I think it's up 8 or 9% would have made money, but you can't do it willy-nilly, and it's not something you can do all the time. Benham will always, if those setting the stops and limits, that's very much the momentum portfolio. You can do it in the low volatility portfolio. I tend to be like Brian. I prefer the chance to make 2 or 3% rather than, I'm after two. And sometimes maybe I will set it a little higher than that. If I feel like, everything is moving in the right direction, then I'm going to give that a little more rein. But those volatility trades are possible by putting all the factors together. What is broad sentiment doing? What are what's occurring across your dashboard? Is demand flat or down everywhere? Has supply turned? All those conditions exist. There's a high probability that you will have a winning volatility trade. Then you have to just wait till it comes. It's really nice to make those gains, but you have to be careful and wait for the next opportunity to come. And I'll capstone that in our Brian's and my discussion about what we think is coming next. Okay. Mechanics of small gains. I've kind of covered that before, so I'm going to skip ahead. I think,
Tim,
Brian,
could I ask you one question? A question coming in from John. Could you just take as an example one of the companies in the momentum portfolio and just illustrate, what it looks like for rising demand and falling supply and what we're trying to track there?
Yeah, sure. So I'll use CR, and this is not a great example, by the way. So if I looked at CRDO, would I immediately, if this is in the entry range, all other things being equal, I'd be interested. I'll tell you what I don't like about this particular view. So it hit 10, it's come down, and it's bottomed here at about 9. And supply shot way over trend and it's coming down. Will this condition statistically produce a gain? Yes, but that's not my favorite condition. I much prefer this, where you have a sharp, you have a steep drop on the supply side and demand at 10. That's how you get a gain. Of course, this was a product of, I think maybe they reported results. I don't know. And so that's a short squeeze where, you get a big pop on the price. People bet the wrong direction. Happens sometimes. They get it right a lot of the times, but not always. Here, if you have falling supply and it's well below the trend and demand's at 10, that's just a great condition. So if you can trade very short term, 1 to 5 days, and then if you have longer portfolios, I mean, you could keep this thing. You could keep it to here. I would have left here. Right. So because now demand has dropped, the price didn't really change. But here I would be out mathematically just because demand deteriorated below 5 and supply began to rise. I'm out, moving on. Right. That's how, if you were using it for longer range purposes, you can check that every day. And it just becomes a very simple way to assure yourself that you kept all those gains, right? You kept all those gains, move on to something else. It's not always going to be right. We had, the month end, they reported results that probably played a key, whatever happened there, played a key role. But that to me is what you want to do. You just look for that over and over. Let's go look at one more and we'll I'm just picking them up, If you write in a line here, WBD, 100% probability under when these conditions exist, just realize options are expiring, can affect outcomes. It's got the very same condition that you see in CRDO, where it rose above the trend, but then this one-day decline while at 10, the Hicks rule, Steve Hicks, what's the probability that if you buy in the entry range, I like to be close to the 1028 level, but you don't have to be. It could be, you could be at 11 with a stock this volatile, and statistically, there's no difference in the outcome. This is what we looked at. What we looked at is prices are volatile, and you don't know how that volatility is going to play out. You just know that it does, and so that's what you do. If you could buy at 11, and you put your thereabouts, something less than that. Then you just put your stop into, it's only 20 cents. You only need 20 cents. And if you got 20 cents, you've made 2%. It can happen very quickly. That's how I would look at it.
Perfect. Brian, thank you. Yep. That was it. Appreciate it.
Okay, let's talk about what's next. So what's next, Brian?
There's a setup. We talked about green line trading in the market desk note this morning. And let me show you what that looks like. So green line, red line in broad market sentiment. I like to think of the red line as the market getting stretched, and the green line as the market basically getting oversold. Let's maybe move this back for a 1 year time frame, and then we'll do the same exercise on a longer time frame. And Tim, you can correct me if I'm wrong, but I think every time that we've moved below the green line, we've had gains. Is that correct? Even if they're short term in nature, we've had some type of gains afterwards. And you can see it here. We move below the green line, market moves higher. Move below the green line, market moves higher. Move below the green line, markets move in higher. And sometimes they can be very short term in nature. If you and let's move this back for a longer term view. If we look at the bear market in 2022, and it'll be a little more difficult to see this, but the whole market was down, I think 25, 26% from peak to trough. Um, you were making gains when we moved below the green line, but they were maybe for a week or so, and then the market, moved lower again. So it really part of it depends on what type of environment we're in. Are we in a bull market? Are we in a bear market? Are we in a transition? But kind of two things to think about here. We are approaching the green line right now. We're not quite there. And our what's this going to look like when we shift from December to January? That's what I'm really curious about. We've talked about this the last two times, but it's been a very clear inflection point. End of December, market higher. Immediately in January, the market turns. Notice what was happening at the same time. It was a very low short volume environment, and immediately in January, we immediately shifted to a high short volume environment, and we essentially stayed in a higher short volume environment from that point going forward. Low short volume environment again. We are just starting to shift higher. What happens in January, I don't know. Right, but we have this setup where green line, the market rallies. Will it be a short-term rally? Or if you look at some of these previously, the last couple of years, we moved below the green line. That puts your chips on the table, because the market's moving higher. So, is it a bull market or a bear market this next year? I have no idea. I do know that, we are getting close to that green line environment, and presently we have low short volumes. That to me tells me we're probably still good for further gains for a little while, but I just don't know, what happens when we shift into January trading. So that's my 2 cents worth.
And I'll add another penny to it.
Yeah.
Ante a penny. So in that same vein, I'll tell you what I think, where we are in terms of, whether do we bottom or does this become something more serious? To add to Brian's observations here, it's interesting to note that, is this going to be far enough back? I think I'm going to do what you did. I'm going to go back 5 years. That's the same principle. So, this look at this very low short volume period, all during the great pandemic boom. And then supply rose above trend, and we had this bear market. And I'm going to talk about that next. And then we get to the sort of the end of that with a big spike. These are where you have really low up here on the demand scale, where my cursor is. These really steep bottoms, one there, one there, one there. So there's the end. We know we're coming to the end of the bear market, the 2022 bear market, and it tends to be capped off. If you go back and look in time, this was true even here at the pandemic. People didn't know, right? So it was a lot of shorting, and then came racing down because money save the day. That's how it manifests. So then you come forward to what happened in here, monetary policy change, right? So we had the era of rate hikes and then the end of the rate hike cycle. And now it's not as steep, but there was a very meaningful downturn on the supply side. And that became the regimen. And then now we didn't know what was going to happen next. Then, this is election and monetary policy. Now, what happens next? Because it's the end of another monetary cycle, the end of the cutting cycle. At least that's what Jay Powell said yesterday. Now, we'll see. Things could change. So that could mean a change in the behavior of the market. Then the capstone to me, thinking about what's ahead, how do we know that this is going to become an extended bull market, or will it be a bear market? Well, we don't know, but you certainly can go look at the patterns over time. This pattern is a bull market, a booming bull market with very strong peaks and a lot of time above 5, typified by a lot of green in there between the red and green lines. And then the momentum dies. It stops hitting, pounding past the red line. And then we start getting dips. We start to get more white space in here. And that is how a bear market develops. It's always true in the data. The data set here is only back to 2017 because it's the only apples to apples comparison we have. But we have data all the way back in a much narrower, less reliable, much higher standard deviation data set is always true. So here, what happened when you start to pop below the green line, yes, it's an entry point. The market always gives you a lift after that. But if it repeats, then you got a bear market developing. Right. So the question is this the first? We haven't seen it yet. Hasn't happened. We haven't been below the green line since April. We haven't had an entry point. So if we do drop below and then we recover and we drop again, whoa, I'm going to be concerned that now we have the bear market conditions, particularly if this reverses course and starts to go at least somewhat higher again. This is not a great pattern to me. These are the patterns that you see in some sense during periods where there's demand supply uncertainty and markets tend to falter. Now, so I don't know, but I can tell you, bull market clearly, a lot of time and a lot of big green patterns and extended ones. Bull market clearly. This has been less of one. It's not, the market has continued to rise. Money hasn't been really coming out of the market, but you look at that pattern and say, well, that's not this pattern, that's for sure. So the question is, could we return to that pattern? Well, yeah, we could. I mean, I think, if the new administration achieves some really substantive changes in government expenditures and the trend in debt and opportunities for business, maybe that changes things. I don't know. I still think we could get a bear market anyway for a short period of time. And I would look at this and say there's a much higher probability of that than we race off to another booming bull market without that interruption first. But we'll see. We're going to watch those patterns. That's what we'll look at. Questions, comments, thoughts? Deep words of wisdom. That's what we're always after.
Hey, Tim, Brian, I just got an observation. First of all, I have to commend you guys for putting up all these charts, which is a very good attempt for looking forward rather than looking at price, which is looking in the rear view mirror. And however,
I knew there was a but coming, Venom. I could tell there was a but coming.
This is just an observation that perhaps markets are not just supply and demand, a two-dimensional thing. There is a third, more important or most important dimension, which is volatility. I mean, economic professor is going to hit me in the head and say, no, everything is supply and demand. Okay, but the markets are n-dimensional. And the third dimension, which I do see on the graphs, the little blips of the green squares, which says option expiration, or all of that. There is an attempt to include that. But wouldn't it be nice to have the third dimension, volatility of the instrument? I mean, for SPY, it would be VIX. For QQQ, it would be VIXN. for any given instrument, it would be its, I don't know, some combination of its implied volatility of the call and puts and all of those things. But in having that volatility hit you in the face, okay, I know some of that is in the demand and the supply and everything, but having that looking at the market in a third dimensional way rather than a two-dimensional way, perhaps we discover some answers to how the price is shaping.
Well, you're certainly right. I mean, the Eugene Fama won a Nobel Prize in economics for demonstrating that volatility largely neutralizes the risk, the risk-adjusted return of equities versus bonds. Right? He said there's really no material advantage over time in equities if you factor for volatility. We say, well, but equities have sharply outperformed bonds. Well, it depends on when you need them, right? If you saved and you saved and saved from 2001 or 2 to 2009 and you needed your money, then all of a sudden you lost 50% of it. And that, so the University of Chicago has done very good work on the effects of volatility. So to answer you, I mean, we're always looking. And by the way, Barry Bailey, we looked at that. I looked at your suggestion about can we move demand forward or back? The problem with moving it back is then we would have to calculate what exists in the future. That's the problem. And so how would you do that? So we tried moving it forward, was there any advantage we could find? We could find no statistically measurable advantage in doing it. In fact, I think it deteriorated some. Now, it wasn't an extensive look, but I had Nate do that, and we reviewed the data, and I thought, okay, well, it's not compelling enough to make the change. But Ben, I'm always open. What we do for volatility, to me, is this. And I know we've gone long, and apologies for that, but I'll quickly answer this. So number one, in all of our portfolios, we are tabulating volatility. The problem, to me, here's the problem with the implied volatility of options and the VIX. They prove to be very lousy predictive measures. We've done that, and here's the reason why. The great majority of people who are buying and selling volatility in the form of the VIX or options are hoping to profit on the change in the price of volatility. So then it becomes a terrible instrument for telling you what prices will do, which is why, so the big question was why, if we all knew, the entire planet knew that this would be a hawkish cut, as they were describing it. All the pundits were calling this rate cut a hawkish cut because he's going to cut 25 basis points and then tell people we're not going to do it again for a while because we need to see how things play out. Well, if everybody knew, why did the market go down 3%? And my answer to that is exactly the unpredictable nature of the value of derivatives. There are trillions of dollars pegged to, think about all the ways it gets extrapolated out. Just take UVXY, which can only exist through a total return swap with someone, Goldman Sachs, and its components may be this thing or that thing. Goldman Sachs is in turn going to hedge its exposure to the swap that it gave to somebody else so that I can go buy volatility or sell it. And then you can buy puts and calls on that. Well, what happens if the underlying known knowns change? Even though we all know, we have no idea what effect that's going to have on prices. So that to me is the problem. So what we've determined is the best thing for us to do is, number one, identify short-term volatility. It changes, but this is what exists. That is your risk at all times. So if I'm going to trade, CRDO, I've got to know going in, I have to be willing to take half that move as risk because my probability is I'm going to get to keep 2% of it. Well, it's a pretty high probability. So we do that. And number two, we do this. We go here, you can see volatility at work. So there's the 7.5%. And then here in the daily trading ideas, which we could extrapolate over the entire data set, and we may do that as it loads, we are looking at how prices move. This is one of the things I used in the webinar for IBKR. I took GME as an example, and I showed how there was no volatility, whoa. Then demand exploded, supply fluctuates, and what happens? You get all this movement between that right here, close, low, high, that is volatility. Volatility is just changing prices. What causes it? And I would say that's what matters more to me. What matters to me is what is causal. Demand and supply cause volatility. Well, what it is some investment purpose or time horizon shows up. Could be a day or less, could be a day or more. But that is what happens. Now, how can we turn that to our advantage? Look, we're always looking for, if we can come up with some way to make this mousetrap better, we'll do it. At this moment, I have not seen demonstrated a way that's better yet. Doesn't mean it's not going to happen. Okay, well, we'll ponder that. Then, I mean, if you come up with the idea, let me know.
No, it's just trying to bring up some discussion.
Yep.
That if
Yep.
we had a way,
Yeah.
if it were possible to have a third dimension more visible. I know that there is a column in some spreadsheet that gives me the volatility on that. But if just had it hit me in the face, like the way supply and demand is,
right,
and I would pay more attention to it. It's very complex. It's not easy.
I agree.
But if there was an attempt at least to think about it, maybe someday that would happen.
Yeah, yeah, I hear you. Hey, we'll continue our search. There are multiple things that we know we could add to improve this, and the reason we don't is, I'm very patient as a business operator. I'm not going to get out over our skis, and as the revenue, the resources grow to invest in engineering, we're going to add some things, but I'm patient about that.